Welcome back to Crypto Meets AI. Harry here with an update for you. Do me a favor, friends. Smash that like button, hit subscribe, and comment down below. Now let's get into this. We got quite a bit to go over. We're sitting at $3.05, trading within the range of $2.98 to $3.06 for about 1.5% on the 24-hour. We need to break through that 3.07 mark with some good volume, and then we should push upwards of 330. But that 330 mark is still a major resistance line. We'll keep track of it and see where we go from here. And this is your daily friendly reminder that XRP in the not too distant future will be an eSDR and considered a tier 1 asset. You are not late. You're in time for the opportunity of your life. Don't let it pass you by. Now let's go down that old rabbit hole. Ripple saw so much of this space before anyone. It started with payments. They knew money was payments. So did Satoshi, and that crypto would eventually disrupt payments worldwide. They built before Ethereum even existed. Vitalik famously slept on Ripple's couch, but banks and institutions weren't ready for public chains back then. Far from it. So they designed software that simply improved Swift. Why? Because Swift was so incredibly shitty that even non-crypto products designed by better engineers were miles ahead. But during this time, they also were pitching everyone, doing trials with everyone, and signing many up for their products, even though these products did not use crypto. But how could they? Clients were not ready. They were ready to test, to trial, but not use. Many weren't even ready for that. They hated crypto. Ripple started the payments trend in crypto. They started the interoperability neutral protocol trend. They started the exporter trend. They started working with regulators and with institutions and with banks trend, but most saw that as a very anti-crypto thing to do. Now everyone's doing it. In fact, almost all new chains are designed literally to solve payments in a compliant within the system way. Their very evil strategy of Ripple 10 years ago is the strategy of most new chains and the most existing one. But Ripple also saw the clients would eventually want more. They'd need custody. They'd need settlement. They'd need clearinghouses. They'd need stablecoins. So Ripple acquired top companies in all these verticals and developed some in-house. They also did this while embroiled in the largest lawsuit the SEC filed. While most of the industry was distracted by NFTs and shady DeFi plays and meme coins, and laughing at Ripple thinking they were dancing on their grave. But here's the iceberg at work. We've only seen 10% that floats. Above the surface, we barely know their client list. We barely know who they worked with and in what way. But today, the second largest bank in Spain expanded their partnership with Ripple to include custody and include XRP custody for clients in a very regulated EU. Ripple has hundreds of these types of clients, and now they have an array of crypto services that they own, and a world that regulators are almost ready for. And Ripple has the full tech stack and all the regulatory licenses worldwide. 90 corridors and counting. This is no small thing. Ripple played the long game, got laughed at for their strategy. Now everyone is copying it and still shitting on them. Do you see how this works? People hate them because Ripple was right and it kills them. And when Ripple and XRP win and win big, it will be their own fault for not objectively acknowledging this. Ripple's time for dominance is coming and XRPL is at the center. The titans like Apple, Amazon, and Tesla built for years. For Ripple and XRP, fruits of those years are ripening. Comment down below and tell me what you guys think. If you found this information valuable, helpful, or hell, even entertaining, please share, like, subscribe, and comment down below. To the SEC case conclusion, Ripple is making huge moves. Millions of XRP are being transferred. Are they preparing for mass adoption or a new big partnership? They have 1,700 NDAs. Who knows what could be happening? But 15 million XRP was transferred and delivered to an unknown wallet. And I would say this is the biggest breaking news I've seen yet. First spot XRP ETF goes live today. The Rex Osprey spot XRP ETF indeed is set to launch on September 12, 2025, marking a significant milestone as the first spot XRP ETF exchange-traded fund in the U.S. The Securities and Exchange Commission, SEC, completed its 75-day review period without objection, allowing the fund to move forward under the Investment Company Act of 1940. This ETF, which directly holds XRP tokens rather than future contracts, aims to provide retail and institutional investors with regulated exposure to XRP through traditional brokerage accounts, simplifying access without the need for crypto wallets or exchanges. And the DTCC now lists Fidelity Solana ETF, Canary XRP ETF, and Canary HBAR ETF. You laughed when I said XRP and HBAR ETFs were coming. You mocked the idea of a Solana ETF. I've been saying it for months. Now it's happening. Are you still waiting for that green candle? Or have you already boarded the train and ready for takeoff? And SEC Chairman Paul Atkins claims crypto time has come. Let's hear what he has to say.
And today, ladies and gentlemen, we must admit that crypto's time has come. For too long, the SEC has weaponized its investigatory, subpoena, and enforcement authorities to subvert the crypto industry. That approach was not only ineffective, but injurious. It drove jobs, innovation, and capital overseas. American entrepreneurs bore the brunt and have been forced to spend fortunes on building a legal defense instead of a business.
And we all know why this happened. The Biden administration appointed Pocahontas, and she is the one that got Gary Gensler, that pipsqueak, the job. He did the banking cartel's dirty work, and the SEC sued Ripple and dragged him through the mud for the next 5 years. And we're just about 48 hours away until the $2 billion in real estate transitions to the XRP ledger, with 558,000 real token burns scheduled. On September 12th, RealFi will execute a $558,000 token burn, causing a strategic reduction that will lower the phase 1 supply to just 22 million real tokens. With over 2 billion plus in real estate value to migrate from off-chain systems onto the XRP ledger, this milestone underscores a major step forward in blockchain adoption within the global real estate sector. Like I said, my friends, I gotta say it, the institutions are here. Now, are you visualizing the endgame for XRP? Every major currency is becoming a CBDC. The IMF already has SDRs as reserve assets. Plug blockchain into that system, and XRP is the missing piece for an eSDR. Call me crazy, but this is the setup we've been waiting for. Now on to some Flare news. Claiming rewards on the Flare network is a full-time job. Every 3.5 days, delegation rewards. Every 14 days, staking rewards. Every 30 days, Flare rewards. Every 30 days, Flare drop. What did I miss? I don't think anything. And Harvard goes cross-chain, September 20th to 21st. Builders will join Flare Networks, XRPL Commons, and EasyA app to compete for $35,000 in prizes across 3 tracks: cross-chain finance and real-world assets, composable DApps and interoperable infrastructure, vibe coding and consumer apps. DLT and blockchain technology is already being taught within the college community. That's where that pipsqueak Gary Gensler came from. He was actually pro-crypto and pro-blockchain technology before he became the SEC chairman. Regarding the NPM supply chain issue, Flare is not at risk. After a full review of Flare and F-Assets operations, we can confirm that Flare operations, Flare Protocol, Block Scout Explorer, and System Explorers, the F-Assets website and codebase are core vault components and are not affected. We've checked all our dependencies and confirmed that none of our affected packages are present in Flare products. Withdrawals from the F-Assets core vault were briefly paused out of caution during this review and have now been restarted. To protect against supply chain attacks, we followed strict practices and took additional precautions during this specific incident. Strict version pinning and mandatory reviews for all packages upgrades have long been required. This is why we're able to complete the review quickly and confirm we were not exposed. Continuous overnight dependency scanning and vulnerability monitoring have been running since the issue was reported. Our security partner was consulted for independent validation. Ecosystem partners and builders were informed to enable broader peer review. Core vault withdrawals were temporarily paused as a safety measure. The security of our users and their assets is paramount. We will continue strengthening these practices to stay ahead of evolving threats. Now on to Hedera news. Grayscale files for S1 HBAR ETF. Earlier this year, Grayscale removed Polkadot and adds Hedera to their smart contract platform fund. The demand for Hedera is growing. You're still early, my friends. Archax launches pool token functionality on Hedera, enabling on-chain multi-asset portfolios. First up, a tokenized basket. Aberdeen UK, BlackRock, State Street, and legal general funds. The range of underlying assets can be diverse too, from equity, debt, funds, and cryptocurrencies, all in a single transferable token. This unlocks unprecedented flexibility in portfolio building and fund creation on-chain. CEO Godfather. The Archax HBAR pool tokens open up more doors than you can think. Essentially, we now have regulated tokenized ETFs. Pool tokens bring forth the potential to birth new baskets of assets consisting of digital assets and TradFi real-world asset. Below, I've drawn up a few examples that all vary by exposure and volatility. Pool 1 showcases one that most institutions will likely be more comfortable with, a large focus on money market funds with slight crypto exposure. Pool 2 brings more of a balance near 50-50 split. And Pool 3, would be suitable for those who are looking for crypto exposure, but semi-limiting volatility exposure. As for the other two pool examples, they showcase how we can now bring diversity into digital assets. In a sense, these can be seen as almost hybrid assets. You're mixing tokenized TradFi assets with the future of digital assets. We've already seen Archax utilize an early form of pooled tokens with their Lloyds and UK digital bond transaction. But now we're seeing Archax expand upon this vision, from instant settlements to creating new hybrid assets, a monumental step in tokenization for Archax and Hedera. I gotta say it, my friends, the institutions are here. Mass adoption is here. Are you ready for that liftoff? Comment down below. Tell me your thoughts. And last up, Salsa Swap Labs is proud to join the Mika Alliance as a verified member. We're working to make DeFi compliance on Hedera faster, cheaper, and more transparent, building within the sustainable regulatory frameworks. The institutions are here, my friends. Well, that's what I have for you folks. Until next time, stay savvy, stay stacking, and I'll catch you in the next one. If you enjoyed this, smash that like button, hit subscribe, and comment down below. And if you want more crypto deep dives, check out our videos right here on Crypto Meets AI. Thank you for watching. Remember to always do your own research. This is not financial advice.